In this episode of the Investor's Journey podcast, I talk about central banking, interest rates, the Federal Reserve, monetary policy, and its impacts to commercial real estate and investing at large. I speak with Jason Brach, who has a tremendous amount of experience right now working for Cross River Bank, but specifically within the Treasury Department and the Commercial Real Estate Department, figuring out logistics, pricing, interest rate risk, and all the above. Enjoy the conversation. Ladies and gentlemen, welcome to the Investor's Journey podcast. I'm your host, Josh Klein, and with me today, I have Jason Brach. Jason works at Cross River Bank, and he specializes in capital markets, interest rates, commercial real estate, and has a wide breadth of experience across all aspects of finance. He's an incredible guest, and I'm very excited for this conversation. Jason, welcome.
Thanks, Josh. Happy to be here. Thanks for having me.
Yeah, absolutely. So I think I want to start out by talking a little bit about your background and where you started from and how did you get to where you are today?
I was a research assistant for a trader at a hedge fund in the city for about 2 years. Then I started working for my dad in the food business, which I didn't really like at all. And through sheer fortune, I got hooked up with this guy who was starting a bank. He just got a hold of a charter, and he's looking for, people who are interested in economics and finance and banking and are not complete idiots. So I started working as sort of his driver. I was really his gopher. I was the 13th hire at a company that now is about 1,000 people. So that was my first job, was his driver. And about 6 months in, I started, I realized I didn't want to be a driver, obviously. I wanted to work in finance and economics for a very long time. And I just figured this was my way in. And about 6 months in, I realized we had a quarterly newsletter. And at the time, I was already very interested and educated in monetary policy and central banking. So I started to write articles about 2014, the new monetary policy tools. Definitely reverse repo. That's when it sort of started becoming popular, which hopefully we'll get to talk about it a bit later. And I started writing about how the tools work. And the CEO decided, he shouldn't be my driver anymore. So I went to accounting. And when I was in accounting, I sort of started to sort of formulate my trajectory to myself. And I wanted to be a capital markets practitioner. I wanted to work in structured finance, but I didn't want to be like every other person. I figured, what if I make my way onto a journey exploring our balance sheet? And then once I get the capital markets, I'll have complete balance sheet visibility and understanding. So that's really what I did. I started in accounting. I was there for 4 years. It was amazing. My boss there he saw me and what I was good at. And then he saw my creativity. And at the time accounting was our only finance department. So accounting was treasury, accounting was capital markets, accounting was everything, finance was accounting. And we didn't really have any frameworks built. So I started to build some frameworks, analyzing, deposits, borrowings, other assets, creating a month-to-month summary for the board. And after 4 years, we built out a treasury team. And perfect. That's exactly what I need for my next balance sheet knowledge. So I went to treasury, and I was there for 3 years. And my next stop was capital markets. So I was on that team, consumer capital markets, for about 2 years. And then I saw that in commercial real estate, I had the opportunity to finally blend that all together, which is what I wanted to do for about 10 years. So now I'm a commercial real estate, and what I'm tasked with now is really it's pricing and analytics. What I'm really focused on is our own on-balance sheet strategy. So it's pricing, and it's portfolio allocation, general analytics, and anything macroeconomic that the team needs to be made aware of, and also general guidance for the team from a macro perspective and from a strategy perspective. Something really exciting we're working on now is onboarding derivatives so we can start offering our clients loans embedded with interest rate swaps to begin. But that's really what I'm focused on.
I think that's fantastic to see your history going from different departments and really shifting your perspective based off of where which setting you found yourself in, whether it's on the accounting side, treasury side, capital markets, real estate, and I think you've been able to, me firsthand, seeing it in you, shift your mindset and your way of thinking, both on a micro and a macro level, because of your different experiences on all sides of the balance sheet and all sides of the industry. So I want to just dive right in. And I think a super difficult task that a lot of real estate investors and other investors at large, whether it be business, stocks, bonds, need to think about is being proactive about the macro environment rather than reactive. So often people are saying that, okay, interest rates are going up, now they're down, now they're sideways, range bound. It's the Fed is going to cut short-term rates, we have long-term rates. And does the money supply? And people are just reactive, and then they decide to make an investment decision. So, in your opinion, what do you
Yeah.
see in terms of the drivers of real estate values or business values from a macro landscape that investors should be thinking about?
So it's a great question, pretty loaded. What I will say first is I don't know if there's one headline item that investors need to think about because it really depends on the market in which you're in. But generally, it is at the same time, it is important to have your finger on the pulse of the economy, no matter what, especially if you're in the financial markets. Um, so I want to talk about the yield curve inversion, if you don't mind.
Yeah.
Um, so as you know, we had a pretty strong signal of an impending recession last year, roughly, um, warning investors or market participants and the world of a coming recession. And it's a lot of time has passed since then. And a lot of people are under the impression that we're out of the woods, soft landing, here we go. The inversion is not a great indicator, obviously.
I just want to
And
interrupt for
that's
one
not,
second. Just for those
yeah,
that don't know, the yield curve inversion is where short-term interest rates are higher than long-term interest rates, which is typically not the case. When dealing with risk, long-term interest rates should be higher than short-term interest rates. And what Jason's referring to as an inversion is where long-term interest rates were lower than short-term interest rates. Yes, now continue, please.
correct. Sometimes
Yeah,
I just assume we're all,
no, that's great.
Um, but yeah, thank you. So a lot of people are under the impression that we're out of the woods. People were talking about this wall of maturities in CRE that's going to really mess up the economy. People forgot about that, it seems. And the fact of the matter is that the average time between the yield curve inversion and a recession starting. Now, the question you can ask, what's a recession? There are certain just agreed upon metrics indicating what a recession is. It can be an unemployment rate, it could be a GDP number. Um, but typically, the time between the inversion and the recession starting is about 14 months. We're in month 14 right now, and it can go as much as 22 months. It can go further, but so far historically, this is an 8 for 8 indicator. It predicted 8 of the last 8 recessions. It has gone to as long as 22 months. So I think that is the first thing investors should be thinking about, keeping in their back pocket the knowledge that there might be a recession and rate cuts might need to start happening quickly. Now, talking about rate cuts, there's a lot of uncertainty um, regarding. There's a lot of uncertainty regarding rate cuts. So as an example, on December 29th, there was roughly a 70% chance, as per the Fed Funds futures market, there's roughly a 70% chance of a 25% basis point cut, 25 basis point cut. That's December 29th. We go now to currently, about a week ago, the likelihood of a cut is now 46%. So it went from 70% market thinking we're cutting by 25 basis points in March. Now 46% is what the market is thinking. So nearly a 50% decrease in the market certainty that the Fed will cut. So there is so much uncertainty around what the Fed will do. Even to add on to that, you look at the Fed dot plot, which is basically showing what all the Fed governors predict as far as rates for the next few years and then to the future. The Fed seems to think we're only cutting about 75 bips in 2024. Goldman Sachs is saying we're cutting 100 bips. The Fed Fund futures market, like I was alluding to earlier, is saying 125. So there's a massive disconnect, and we still have this commercial real estate wall of maturities. Now, why didn't it happen yet? It didn't happen yet because workouts. Commercial real estate is not the same as residential real estate. That's one. Number two is banks don't want to have defaults on their books. That's the fact. So if they can extend somehow, some way, they will extend. You think about commercial real estate, a lot of these loans, let's put aside multifamily for a second. A lot of all the other types of commercial real estate are interest only for the most part, or a large percentage is interest only for the most part. When it's interest only, workouts are easier. There hasn't been any principal that the borrower is behind on. The payments are less per month. The DSCRs are probably going to be easier to make them look good, basically. So extensions and modifications are much easier in the commercial real estate world. So the CRE wall of maturity, in my mind, has just been pushed off a bit. We're still facing that same problem. And by the way, all of what I'm saying is lining up perfectly with the fact that there's going to be elections in November. So that's what I think. I think the prudent investor needs to understand that it might be time to increase their bond allocation because the Fed might start cutting rates hard. The average investor should be thinking about their portfolio. They should be looking at the liability, the debt of the companies they're investing in. If they're they should be looking at companies to see when they took out this debt, what type of debt it was. If we're talking about companies that took out fixed rate debt over the last year, then you probably want to stay away from those. You're talking about companies who are using floating rate debt, and also obviously all other metrics being, there are other things that investors should be looking for, but purely from a macro perspective, I think that you want to find companies that are heavily exposed, obviously that are profitable and heavily exposed to the floating rate debt structure. And as far as like what type of equities to invest in, I would probably start looking to maybe shift towards more utilities, and guys like Verizon, guys like AT&T, and some stalwarts. I would also be really, one more thing to really consider is Freeport-McMoRan, the FCX, the leading copper miner probably in the world. They have historically been a very, very solid indicator of near-term economic outlook. Right now, the chart of FCX looks very uncertain. So it's something to keep an eye on, and it's definitely something the average investor should be watching as well.
So it's interesting when you talk about the consensus, although it's changed over time about how aggressive the Fed is going to cut rates, but the consensus overall is that the Fed will cut rates sometime this year, and we don't know exactly how many times or how many basis points, but they likely will see rates go down. But what's interesting is that is the control over short-term rates. And long-term rates are still typically market-based, based off of auctions, based off of market makers and other participants looking to participate in that form of the financial markets. Where do you see the long-term rates going? Just as a baseline, Howard Marks is a fantastic investor, and he's recently came out saying that he believes long-term interest rates are going to stay a little bit longer, a little bit higher for longer. So where do you see long-term interest rates going, and how is that going to impact real estate owners and other investors?
Sure. So, firstly, it's great to hear that I'm thinking along the same lines as Howard Marks. I'm a pretty loyal follower of his. Um, so very simply, so let's first talk about a little bit why short rates are different than long-term rates. The real reason why longer term rates are market rates is because the Fed only has control over short-term facilities, right? The IRRB facility, which is an overnight facility, the reverse repo facility, which is an overnight facility. So long-term rates are going to be based on whatever the market thinks. If the market thinks the Fed will still have to cut over the next 2 years, that's going to be reflected in 2-year bonds. So when we talk about long-term rates for short-term rates, I want to sort of put that in the context of, we all know the Fed will cut. The question is when, and that's what the sort of delineation between between bonds along the yield curve really have to do with the timing of the cuts and the timing of a recession. Because if we think about it, if if over the next 2 years everybody thinks we're going to have 200 basis points of cuts, but they won't necessarily start happening until mid-year two, then you're going to see longer term, but you're going to see 2-year bonds start to be priced very differently than short-term bills, than 12-year, than 1 month or 12 month down below. Now, what I see for longer term is exactly what Howard says, and that's simply because Treasury issuance. It's two reasons. Number one is Treasury issuance is going to be about $1 trillion net issuance every year for the foreseeable future. That's what everybody's saying. I don't know, and nobody knows for sure. The second thing is the reverse repo facility. Now, the reverse repo facility, that's where these money market funds, they're where money market funds keep their money at the Fed. And what's been happening is that money market funds, they always look for the highest short-term rates. So what they've been doing is they've been parking their money at the reverse repo facility. I'm going to call it the RRP. And as attractive bonds come out, they shift into bonds. Now, the facility balance was 2 trillion at the peak. Very, very quickly, I'm talking about in a matter of half a year, it fell to 600 billion. So that all that money is going away very, very quickly. So who's going to be purchasing all these longer term bonds? So as we know, there's an inverse correlation between price and yield. So if we think demand won't keep up with supply is really what I'm saying, then yield on longer term bonds will remain elevated. And this ties into what a lot of people in the rates market are saying, that what we're going to end up seeing is a bull steepener, right? It's going to be a bull market in bonds, but the bull market in bonds is not short term, is not longer term rates rising higher than short term. It's short term rates falling faster than longer term. So similar to what Howard says, rates are going to stay high for longer term bonds, but will come down pretty quickly because of the Fed cuts for short term bills.
Fascinating when you speak about the reverse repo facility as a short-term facility that money market funds are utilizing to get access to yield, and it's slowly dwindling down to zero. And eventually, there's going to be a net issuance of potentially longer-term bonds that the Fed has to issue in order to fund the government spending and the deficit and the large debt loads. There's not going to be as much of a demand for those assets, and therefore long-term interest rates, like you just said, are likely to go higher. So as a real estate investor, when you think about a 5-year horizon of your investment, when you look to buy a property and you want to sell it in 5 years at an exit cap rate, that exit cap rate might be a little bit higher than what you would anticipate, given that cap rates are a reflection and a direct result of interest rates. So if potentially in, say, 3 years from now, interest rates are a little bit higher, that exit cap rate will likely still stay elevated, and that could adversely impact one's investment. Do you agree with that?
Yeah, that's I agree with that, and this is why I am of the opinion that banks and lenders will increasingly shift their lending strategy to more and more floating rate. Even so let's talk about multifamily for a second. Multifamily, right? Most people who know CRE, they think CRE they associate with floating rate loans, except for multifamily. Multifamily generally is right. There's a fixed window, and then it adjusts, and then there's a fixed window. So there's a longer fixed period, and I really think that fixed period will the intervals at which those happen. I mean, so those fixed periods I think will become much shorter because we are no longer in a zero interest rate environment, and banks are will be less and less comfortable committing that duration in the new normal. And the new normal again is rate uncertainty, and which is normal.
Yeah, so I want to switch over and talk a little bit about liquidity in the market and the overall strength of the banking industry. As an investor, of course, the lifeblood of commercial real estate success, or any investment success for that matter, is ability to get leverage and access bank capital. So with interest rates kind of being a little bit unpredictable, what's the status of the banking industry, and how is the overall health? Specifically to some of the regional banks that have tremendous exposure to commercial real estate.
So from a liquidity perspective, I'm not very concerned at all. The there the From a liquidity perspective, the only place I'm concerned in two places actually. Number one is they're shutting down the BTFP, the Bank Term Funding Program. Now, a little bit about the Bank Term Funding Program. It was introduced in the wakes of the Silicon Valley Bank crisis, and it was directly structured and designed to address those issues. And those issues, as many listeners know, and as you know, those issues has had to do with securities, not loans. Those issues were when you have securities that are held to maturity, and then you start getting deposit flights. You're going to have to mark that to market, which will hit your capital. So basically, short story is when you buy bonds that have a fixed rate and then rates go up, and you have those bonds as mark to market, that means you're taking a massive hit because those bonds are valued at a lot less, right? Think about like if somebody has $100 bond at 5%, rates go up, market rates go up to 6%. That bond is no longer going to be 100 because it's only 5%. It will reprice to 6%, which is going to be below 100. So this BTFP facility was set up so that banks can pledge to the facility par value of their securities, meaning they're taking something that would be marked to market, but they're pledging it to a facility that will not market to market, and they'll be able to borrow against that at par. And so now what banks ended up doing was, I'm sure banks used it for a period to help to actually provide assistance to their balance sheets. What ended up happening was banks started using it as just an ARB tool. So the BTFP, the cost of those funds that banks borrow, is based on a 1 year index, OIS. So as you know, we're in the inverted yield curve environment. So that means it's going to be cheaper to borrow at 1 year than it is going to be to borrow at 1 month. So banks would pledge security to the BTFP, borrow at 1 year OIS plus a spread. OIS would just be the most widely used index for that period. So we can use SOFR, 1 year applied SOFR as the OIS. That's going to be cheaper than 1 month SOFR or 1 month Fed funds. So what banks ended up doing was pledging securities to the BTFP, borrowing at 1 year plus 10 bips, then lending in the Fed funds market, which is overnight, which again, since the yield curve is inverted, is more than so 1 month money, because the inversion is cost more now than 1 year money. So banks have just been arbing that opportunity, and regulators are realizing that, and they're planning on shutting it down in March, which works perfectly with when the Fed plans to start cutting. And I say that with a lot of sarcasm. I think we're probably going to need it, so it might be a mistake to shut it down. So that's one of my concerns about bank liquidity. The second concern about bank liquidity is going back to treasury issuance. Who is going to be funding all that debt that the treasury is going to be net issuing every year? It's not going to be central banks. Central banks have largely removed their bid from the U.S. bond market. Globalization, as everybody knows, is no longer a thing, at least now in the financial markets. So those two things are concerning. Now, where we are now, a lot of people have been saying, there's a massive flight from community banks. That's not true. Community banks have been competing with bond rates, with money market rates, with reverse repo rates to keep those deposits. I did some analytics on this, and deposits decreased about 1% only since the peak in 2022 for smaller banks. That, when I say small, I just mean not in the top 25. Now let's juxtapose that with the top 25 banks. Their deposits since the peak in 2022 decreased by 6%. So 1% for small banks decreased, 6% for larger banks decreased. So right now, I guess the upshot is right now, community banks are in a great place liquidity-wise. I do worry, because of treasury issuance and because of the BTFP being shut down, I do worry about the prospects for the next few years. But currently, I don't think there's reason to be concerned about the liquidity. Now, let's talk about the asset side for a second. Commercial real estate. That's the bogey. That's what everybody's afraid of. And commercial real estate, like as I was sort of rationalizing earlier, we're not out of the woods by any stretch there. So while I am concerned there, it is different from, let's say, in 2008 when we had the residential loan crisis. It is very, very different. Commercial real estate loans are cash flowing. Investors will buy them at a certain price. If you compare that with homes, with the home is not cash flowing, and if a person can afford it, a person can afford it. That's it. And they're all amortizing, so the payments are much higher. So with CRE, while there is this wall of maturity people are worried about, I'm worried about, I do think it's important to remember it will be different from 2008 crisis. I'm not saying there will be, but anybody who thinks there might be a crisis, it will be different because it will be a crisis of cash flowing assets. Now, one more thing I want to mention. 2004 to 2006, the few years leading up to the great financial crisis, the Fed raised rates about 400 bips, from 125 in 2004 to a peak of 525. Okay? Right now, we did a similar thing at a much quicker cadence, right? 3 years then versus 1 year now. However, during that period in 2004, 2006, there was about $50 billion of reserves amongst every bank. You take the total in reserves amongst all banks, about 50 billion. So juxtapose that to now, right? There's about $3 trillion in reserves. So if I think about the similarities between 2008 and the precursor to 2008, right? right, after a long period from 1987 to 2001, having like basically rates at zero, and then raising them, we're in a similar position now. Now, the argument could be made, well, that was over the 400 bip raise over 3 years. Now it's a 500 bips raise or 450 bips raise over 1 year. True, but the reserves were only 45 billion during that time. They couldn't raise rates 400, 500 bips in a year with 45 billion in reserves only. So one argument I could potentially make is that 400 bips over 3 years against 45 billion in reserves is the same thing as 400 bips in 1 year when you have 3 trillion in reserves. So one can say, oh, we're making the same exact mistake. We're about to hit a crisis. We were in zero rates for 20 years, for way too long, and now we're raising fast. And relative to the reserves that were outstanding during each period, 2008, 2023, I would argue there's some room to see similarities there. And back to your question about what should investors keep in mind, this is maybe another thing that maybe there's still a possibility that we're in precursors of a big crisis. Again, I don't know, and I hope we aren't. And I am a worrywart by nature, and I work in banking. So again, like, in banking, there's always going to be reasons to be afraid.
Bit. Demand has gone down, long-term interest rates likely will go up. But another reflection of interest rates is understanding what the real rate of returns are for the Fed funds rate. And that's usually a reflection of inflation. And many people believe that inflation has really tapered off a little bit. And it's almost to the point where we've reached our goal of a 2 to 3% constant inflationary growth metric on an annual basis. Where do you see inflation going once we cut rates? And how is that going to impact the everyday consumer and the everyday investor?
So inflation is a lot more complicated than most people think. And a lot more goes into inflation than most people think. And then anybody really knows. So I'll tell you what I know or what I can assume. The deglobalization issue is a headwind for inflation. It will cause it will put upwards pressure on prices. Now, I don't think inflation is a big threat, to be very honest. And there are a few reasons. No, the first reason, well, actually, there's one reason, and I'll give you a reason why inflation is a big threat. So the reason I think it's not a big threat is basically that it's so easy. The moat to start a business and to start a competing business with somebody else, right? To start a business, let's say you want to start a new cheaper Lululemon. It's extremely easy if you want to. Right now, the world is so competitive that prices naturally are always going to be forced to go to their lowest point. Now, again, that doesn't help things if deglobalization forces sellers to pay more for their raw goods. So deglobalization is the main reason I think inflation is a huge threat. Now, I want to say one more thing that might be a little controversial, and a lot of people aren't really thinking about. The propagation of credit and the availability of credit, especially BNPL. BNPL is sometimes doesn't even show up on a credit score, on a credit report. Sometimes they don't even check your FICO to give you a BNPL. So if the price of something is raised by 10%, an argument could be made. According to me, I'm not really seeing that increase. I'm only really, if we split the BNPL payments right into four, I'm seeing a 2.5% increase. So inflation doesn't look threatening until all of a sudden it's impossible to get a grip on. So this is what I'm sort of saying. I think the world order is changing a lot, and what inflation is and what causes it is changing a lot. And there are so many counterbalancing forces that are going on right now: deglobalization, the expansion of credit, um, and then back to a super competitive production market.
So y'all make great points, especially the deglobalization of the world economy, consistent unrest in the Middle East, with shipping rates, just in general moving away from the dollar, and a lot of oil trades over in the BRICS countries, being China, India, Brazil, and those countries over on the east. It's all going to lead to higher inflation over time. And the government operates, as you mentioned, with net issuances in the $1 trillion playing field. And it's likely going to continue to rise over time as the cost of goods go up and as our spending continues to rise. So what does that mean for fiat currency in general, the US dollar, and how does that play a role potentially with cryptocurrencies or other forms of assets to replace that?
Yeah, absolutely. So, so, so I kind of think, I mean, I think we both agree. I'm pretty sure we both agree that fiat currencies, they're abused. They're very easily abused by those issuing them. I mean, seniorage power is really difficult not to abuse, frankly. Um, so there is value in finding a finite currency. Now, a lot of people are saying that the finite nature of crypto is one of its selling points to be currency. I would argue it's one of its selling points to be a digital precious metal. Um, I would, I think there needs to be the ability to expand your monetary base if needed. I think that's important. I think that won't be important. There will be a time where there won't be important, and that's when I think government becomes less important and governmental authority becomes less important. I think then maybe crypto will have its day. But as of right now, I think the finite nature of crypto makes it similar to like a gold investment. I do think it's an attractive investment. It's really taking advantage of the modern technology stack in a very attractive way and in a way that you can really build on. So I think that is extreme. That will play a massive role in what currencies look like once government borders sort of are muted. But I think right now, once as long as we have governments in power, a finite currency is the last thing they're going to want. And one more thing is, and this I think you and I spoke about, but the ability to have a physical dollar and to avoid being tracked is very valuable for people. Right now in Bitcoin, one of the beauties about Bitcoin that it's impossible not to be tracked. So
Right.
that's another reason why I think that when we have a fiat authority, a fiat system, it's very difficult for me to see the benefits of Bitcoin as a currency. But again, when government's border become muted, um, I think Bitcoin will play a much bigger role.
Yeah, it's interesting, and I think it plays a role in how people look at investments because generally, when one denominates a certain investment in U.S. dollars, they assume wrongfully, to be honest, they assume that the U.S. dollar stays constant in terms of its value. And in general, when you look at a real estate investment, you want to
Right.
get a positive IRR, you want to get a positive return, maybe in the 12 to 15 to 20% range. But if we live in a world where the inflation kicks into overdrive and it turns out to be not 2 or 3%, but closer to maybe 4 or 5% annually with this deglobalization that you mentioned, I think people have to start looking at investments in a different light. And I think that equity premium people had associated with certain investments like large cap stocks or traditional real estate assets are going to have to go down a little bit to compensate people for that inflationary risk that they might not otherwise have been protected by. And on top of that, expenses generally go up, with inflation. Look at insurance, taxes this past year, and I think it's going to be really interesting shift in mindset when we shift over to a higher inflationary environment as we look at investments.
Yeah, I agree. And listen, that sort of lines up with this sort of uncertainty around the 60/40, right? Is our bonds going to always be the protection against inflation? And probably not.
Yeah, I think exactly. It's going to be an interesting shift. So we've been talking for quite some time now. So I think just to wrap it up, is there any parting words, wisdom you can share for an investor looking to just go about their journey, understanding the markets on the macro side and how it really impacts them on the individual basis?
That's a tough one because I have a lot of advice I would want to impart, but I guess the main thing is don't overthink things, and that's not to say don't think. That's to say think, strategize, and then have the courage to pull the trigger, because a person who's 10 times as dumb as you will be 10 times more successful because they're too dumb to doubt themselves. So do your research, say I don't know as much as you can. Go on LinkedIn, look stupid, ask questions, because knowing isn't fun, learning is fun. And it's just the fact of life. And then just pull the trigger. And obviously, um, exhibit solid risk management, and really try to stack the odds in your favor, right? So like a big this ties into bond convexity, but think about reward convexity, right? Like make sure if you lose, if you're wrong by much less than you are if you than you win if you're right. That's it. As far as a one,
Good. That's good.
as far as a quick one.
That's great. No, Jason, thank you so much for joining. It's great to hear different perspectives, especially someone like you that has an eye for the macro components of the markets, but you've also have real life experience in some of the intricacies on the micro side as well. So I think it's a great insight, and I appreciate you joining the show.
Of course, pleasure to be here. Thanks for having me.